Hello and welcome to the Hotel Investors Marketplace produced by Hotel Brokers International. I'm Charlie Fritsch, President of HBI. The Hotel Investors Marketplace is designed to provide the most current information in franchising, lending, and valuation, as well as provide an opportunity to preview recently listed hotels. While everyone gets signed in and comfortable, we will highlight a few HBI member listings on the screen, and I'll take care of a few housekeeping items. Hotel Brokers International is the leading hotel sales organization with more than 50 hotel brokerage specialists. Founded in 1959, the organization's broker professionals have successfully negotiated more than 10,000 hotel real estate transactions and annually account for 48% of all mid-market and economy hotel sales in the United States. Visit HBI on the web at www.hbihotels.com. If at any time during this webcast you have a question, just click on the Ask a Question button found on the gray bar located at the top of the webcast player. Type in your question and submit it. We'll answer as many as our time allows. Please let us know how we're doing. Rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. Later today, this webcast will be posted to the HBI website at www.hbihotels.com for on-demand viewing. For nearly 20 years, HBI and Lodging Hospitality magazine have sponsored the annual Hotel Financing Survey. The survey is distributed to more than 200 lenders and inquires about the types of hotel lending and available in the market, requirements for generating hospitality loans, and opinion on the status of the lending industry. Today I'm pleased to be joined by Ed Watkins, editor of Lodging Hospitality, to discuss the results of this year's survey and the state of the hospitality lending. Ed, welcome.
Thank you, Charlie. It's good to be here, and we do value the relationship we've had with hotel brokers over the 20 years. As Charlie has said, we've done a survey every year talking to lenders about where they are in terms of financing to the hotel industry. And today I was going to talk a little bit about that survey as well as sort of an overview of the financing environment, the way we see it, some of the trends in the hotel industry, and what's ahead, again, from our viewpoint for the hotel industry in terms of transactions, financing, and just general trends. This is actually a very good time to give this kind of presentation because I and a lot of people just got back from the NYU investment conference earlier in the month, and there it's a good place to really get a good sense of what's happening in the investment side of the business anyway. First up, I'd like to talk a little about the financing environment as we see it. Everyone seems to think that transactions are on the rise. The question I think everybody has is when that's going to happen. During the NYU conference, Art Adler from Jones Lang LaSalle had said, and this may be some hyperbole, but he said there's great deleveraging is coming in the industry in the next 5 years, and he said that to look out for epic volume of transactions. That's quite a strong statement, but we will see. JAL forecasts that there's going to be about $15 billion worth of transactions this year. That is of deals that are $10 million or more. But through May, there's only been about $5.1 billion, so seems to be a little bit behind schedule, at least for what the forecasts are. The good news is, I think for everybody, is that hotel values are moving up quite rapidly. HVS says that both this year and next year, values are going to move up 17% on an annual basis. Now, that sounds great. Of course, the other side of that is in 2009, values dropped 31%, so we still have a ways to go before values get back to kind of pre-recession levels. I think, and a lot of people believe that people are looking at these valuation numbers rising, and a lot of owners who may have thought about selling their property, maybe hanging on for a little bit to see how far these values do rise. So that's going to be something I think to watch.
You mentioned
sure.
deleveraging. Does that mean owners are switching debt for equity, and that do you see more equity coming in and restructuring of the capital stack?
Most definitely. I think a lot of owners, even those who didn't really get caught up in the financial morass the last couple of years, I think a lot of them are looking to refinance to bring new capital in to, maybe take out some funds from their properties, partially in many respects to try and buy some new properties, because people believe there's going to be opportunities on the horizon. So I think a lot of owners are trying to deleverage in order to put that capital to another kind of use, either buy hotels or even develop hotels. One of the other interesting things I learned at NYU, and again, whether it's true or not, who knows, somebody had mentioned that, and I don't know where they got this number, but there's $30 billion of capital presently waiting to do hotel transactions. But there's just not enough deals, according to these folks, to deploy that capital. And again, it goes back to this rise in values and people kind of digging out of the hole. So it seems as though there's fewer troubled hotel loans that are coming to market than everyone thought. So I think that's where there's that disconnect between a lot of capital chasing too few deals. The other thing that we see, and everyone has seen, is that there's probably going to be a new wave of mergers and acquisitions in the hotel industry. So far this year, Blackstone bought Motel 6 for almost $2 billion. And then early last month, Marriott bought the Gaylord brand and the Gaylord management contracts for a little over $200 million. So everyone seems to think that there's going to be more brands, management companies changing hands. Red Lion supposedly is on the block and maybe the next to go. So I think that's something else to look out for.
Yeah, as a broker, we're seeing kind of a new class of players, and that is equity funds of various sorts who are anxious to back qualified professional hoteliers who have some equity but need more equity and partner up with them. Sure.
In fact, that statement about the $30 billion was given at a panel of private equity people. So I think that ties it directly into what you were saying. I think one of the best quotes I heard at the NYU conference is on the screen now, and this is from Michael Murphy of First Fidelity. And he's saying that there is a lot of money, but people just need to be patient. Times are different than they were, a decade ago or even 5 years ago. And he said anyway, that it takes about twice as long to secure capital today than it did just 5 years ago, which can be disconcerting to someone who particularly was used to getting access to capital very quickly. It's there. It just seems like it's taking longer to get to it.
Yeah, I can certainly agree with that. I know we have buyers who have bought hotels before, and they say, "Oh, I've done this, this SBA loan, or I've done this kind of loan before, and it didn't take this long. Why is it taking this long?" Well, underwriting is more stringent. Every T is crossed and I is dotted, and a little more documentation and attention to detail.
Sure. As I wrote not too long ago in a blog, 6-7 years ago, I'm a lowly hotel journalist. I probably could have got a loan for a hotel back then. It's different today. You have to be a sharp entity in order to get money. Let's talk a little bit about the state of the industry, where we see things are. Obviously, it's been a huge difference in the hotel business today than it was 5 years ago. 2007, everyone was at the top of their game. It was the top of the market. And then just a year later, everything fell off the cliff. And things are really improving. There's no question about that. But hotel performance still isn't back to the pre-recession levels. PKF and STR say that it's going to be probably 2014 or 2015 before we get back to that pre-recession levels of performance. But that number seems to keep going further out. At one time they said it was going to be 2012 and 2013. So who knows exactly when we're going to get back to where the industry was, if we ever were. One good sign, however, in recent months is that last year it was mostly occupancy which was driving RevPAR. And while that's good, it's not as good as ADRs driving RevPAR. Just this year, that's turned around, and on most months now, the biggest component of the ADR lift is in rates, which is really good news for the industry because, as we all know, it's ADR is what you take to the bank,
Makes it more
not
profitable.
occupancy, of course. And as it always is, performance in the business just depends on what segment you're in. The luxury and the upper upscale segments really fell off the cliff the first and the hardest when the recession hit, and now they've kind of roared back quite handily. Their occupancies and rates are up. There was just recently a study by PKF, and they believe that that's going to change in the coming year or year or two. They think that more moderate hotels are going to start outpacing even luxury in performance improvements because there hasn't been very much luxury product built. They're starting to get filled. Their occupancies are high. They're really jacking their rates up. You know, their $1,000 hotel room in New York City is back. So as that happens, I think there's going to be more people looking toward less luxury properties, more moderate tier properties, which is good for everyone.
You think it'll just sort of the recovery occurring greatest in the luxury and upscale or upper upscale is going to filter down from the top down through upscale and then to mid-market?
Right, yeah, it's just going to start trickling down as luxury hotels fill up and raise their rates. You know, people who at maybe this time last year could afford a Four Seasons are now going to look at a Sheraton instead. Mm-hmm. So it's good for everybody. There's also been a lot of talk and accepted wisdom that there's no new hotels being built, and certainly supply has been down in recent months and years. But you know, it's just a question of as the industry starts to perform better, investors become more interested in the industry. I'm thinking that new construction is going to come back quicker to this business than what the forecasts are. So we'll see how that turns out. And certainly low levels of new construction are really great for operators, and it's part of the reason that values are being driven up.
Yeah, definitely.
STR, go ahead.
I was just going to say, we're seeing some new construction projects, but it's simply requiring more equity. And until you see the loan to values rising on new construction, I think it'll still remain at least greatly reduced from where it was before.
Sure. Yeah, it's still muted, no question about it. It's just a question of when it's going to start picking up. STR recently, just the other day, released their May hotel performance figures, and again, it was another good month for the industry. And I think the key thing here, again, is that RevPAR ADR is driving the RevPAR a little bit more than occupancy, and that's a very healthy thing for the industry. Another thing in their forecast is they're looking at profits this year of about $21.6 billion, which is up 19% over the year before, but still below 2007, which was the kind of the benchmark year for profits in the industry. They were about 27 billion, I think. So we're going in the right direction, but still ways to go.
Yep. Now these the stats on this slide, the ADR up 4.2%. That is compared from January through May of 2012 compared to that same period in 2011?
Exactly. Yeah, year-to-date comparison versus last year. The other important thing on this slide is in Q1, according to STR, there was a record number of room nights sold in the industry, which is good. Obviously, it's with supply being muted and demand increasing. It's only going to be a good sign.
Yeah, it's awesome.
Mm-hmm. Some general thoughts I had on what's happened in the industry. I don't think anyone really expected the hotel performance indicators to turn around so quickly. I think everyone thought we were going to come back very slowly, but it is really the industry has outperformed just about any expectations we've had. The other interesting thing is for years, the hotel industry, tourism in general, was very much disrespected by Washington. It was thought of as a frivolous industry. It never got its proper dues. Slowly but surely, that seems to be coming around. Earlier this year, President Obama announced a tourism strategy, which is the first ever in the history of the hotel business. Brand USA started up, which is a private-public partnership between the government and private industry to boost tourism to the U.S.
Yeah. That's got to be a good thing.
It's a great thing. Now, there's a downside to that, too. While these are positive signs, there's still some things kind of nagging at the hotel industry, and that's mostly from the bureaucracy, the federal bureaucracy. The National Labor Relations Board is getting tougher on the hotel industry, and as probably everyone's been following, this regulations from the Justice Department regarding the pool lifts has been very nagging for people. So it's sort of a yin and a yang. On one hand, the government and lawmakers are starting to understand the value of tourism as an economic engine. On the other hand, they're still kind of nickel and diming the industry, which is not good.
Yeah.
One of the things at NYU that struck me, I believe it was Mark Hoplamazian, the CEO of Hyatt, said that the question was about the effect of unemployment, high unemployment on the hotel industry. Something he said I thought was interesting is that the key demographic for most hotel companies are people with more upwardly mobile people with college educations. And as he pointed out, people with college educations, their unemployment rate is only 5%. So if you look at that segment of the population that really does most of the traveling, that probably accounts for the reason that things are doing well in the hotel industry. College graduates, executives tend to have a little more confidence about the future and are going to be traveling both for business and leisure.
Yeah, that's great. Now, and I was intrigued by this. You mentioned on the slide, demographics, psychographics are in our favor. Is that what you were talking about in terms of the unemployment for college grads being lower?
Right. Yeah. Everyone kind of looks at the headlines. Unemployment's 8% or so, and that seems like, well, then nobody's going to be traveling. But in reality, the core demographic of travelers are more upwardly mobile and probably still are traveling. They're still wary and everyone's still a bit on edge, but it's still a good sign for the industry. Yeah.
I wonder if anybody keeps a stat of number of room nights sold relative to U.S. population?
That's a good question.
Because when I saw demographics, I was thinking of, population growth and number of rooms available and number of room nights sold relative to population.
Right. Yeah, that's interesting. Something to look into, actually. One other thing that we've been seeing is that the hotel brands have become more aggressive to their franchisees during the recession. Nearly all of the brands pretty much let up on their franchisees, their owners, in terms of enforcing brand standards, enforcing PIPs, introducing a lot of new expensive programs. Well, now that performance is better, that's turned around, and the brands are becoming more aggressive. They're making their owners, come up to code, as it were, and from a transactions point of view, that's something that adds to a transaction cost. Just about any branded hotel that changes hands today, there's going to become a PIP at the back end of that. So any transaction, that PIP cost has to be figured in what the real cost is. 2 years ago, you could probably transact a hotel and you may still have to do some PIP, but they were going to be a little bit lighter on you. That's not going to be the case today and in the future.
Yeah, it's interesting you say that. Just before this webinar, I was at a meeting at a hotel that we have under contract of sale with the buyer and the seller going through the PIP from the franchisor. And I hadn't seen this before, but the franchisor has 5 phases outlined in the PIP, including phase 5, which is 4.5 years out. But they're wanting them to basically commit to it now. I guess rather than have to come to them later to try to renegotiate it. But
sure,
it does seem that the brands are becoming more aggressive on it.
There's another side to it. However, given that new supply is very low, and you can only convert flags so often, that the brands while they're talking strong right now, and I think they are being more forceful than they were in the future, I think they're still somewhat flexible because brands can only afford to lose so many properties from their systems. So I think the key thing is while they're enforcing these PIPs more strongly, they are more willing to sit down and talk with owners about alternative ways of doing a timeline, as you say. So it's not all bad news for owners, even those who are buying a property.
Sure, and of course, the strongest brands have the least flexibility,
Sure.
and the weaker brands have the greatest flexibility.
Sure, exactly, and that's the way it's always been. Looking at some of the forecasts for 2012, this is from STR, and again, it reinforces that point I made earlier that ADR is what's really fueling the RevPAR growth this year. And as you can see from this, supply is way down. It's way below the norm for the last 20 years or so. And looking at 13, it's pretty much the same, but as you see, supply growth is moving up a little bit more toward the norm. But again, ADR looks like it's going to be fueling the growth in RevPAR. And as you can see, occupancy isn't going to grow quite as much in 2013, at least it's the forecast, than it's going to do in 2012. And I think part of that is because as occupancy is rising, operators are becoming a little more aggressive with their rates. So it may mean a little bit fewer people are traveling, but they're going to be paying more, which again is all things being equal, that's better for operators.
Yeah, definitely. What is the long-term average supply growth?
It's about 2% over the last 20 years. Now that's had some huge fluctuations. Everything from 5 and 6% back in the mid-90s to what it's been the last couple of years, almost zero. So, averages are hard to, sometimes tricky. But anyway you look at it, supply growth is way down from what it could be. Of course, there's always a couple things that can always, throw a wrench into the works. And one of them is what's happening in Europe. Every day the stock market, it seems, responds to what's the latest crisis or the latest, perhaps, resolution of the crisis in Europe. And no different in this business. Who knows what's going to happen if, Spain defaults, if, the Eurozone goes away, if all those kinds of things. We just don't know what kind of repercussions that will have in the U.S., will have in real estate, will have in the hotel industry. Interestingly, at NYU, someone had made a comment that, while everyone is, looking at the headlines and following this on a day-to-day basis, he said that, your local banker, if he's thinking about making a loan on a project you have or a deal you have, he's probably not as concerned about what's happening in Europe as you would think, which is an encouraging sign, whether that's true or not.
Yeah, I mean, from what I've heard, even the larger U.S. banks are fairly well insulated from the European debt directly. I think it's the indirect impact that everybody worries about, and of course, the impact to our exports to Europe and that kind of dampening effect on our economic growth because of their recession. But I think you're right. When I talk to some smaller local bankers, it's more about the specifics of that market and that transaction and that borrower.
Sure. All politics is local, as they say. So,
right.
The other problem, of course, is the U.S. economy and consumer confidence. If it doesn't continue to get better and not get better even quicker than it has, that can be a problem. Another issue is the so-called fiscal cliff at the end of the year, at which time the Bush tax cuts expire, perhaps, and then also, too, more importantly, the mandate from Congress to cut all government spending could have a huge impact on a lot of businesses, including the hotel industry. There was a headline last week or story last week that Lockheed has sent notices to, I don't know, 20,000 workers, something like that, saying that they may be laid off at the end of the year, because the idea being that if this mandatory budget cuts go into effect, the defense budget will be cut by X percentage, and it's going to have that kind of trickle-down effect. So it's going to be interesting to see how that all plays out. And of course, that all ties into the election. It seems as though everything is kind of standing still right now until after November, and everyone finds out what the next 4 years is going to be like. And no matter who wins, I think it's at least everyone's going to have an idea of what the direction is going to be for the following 4 years. So hopefully that's going to get people off the mark again.
Right. Yeah, I think the biggest thing is simply the uncertainty as to what's going to happen, and ultimately, I think people are beginning to realize that the president doesn't control everything, and some things are pretty inevitable, such as the tightening of the federal budget, regardless of who's in power.
Sure. Yeah. Obviously, the other big concern are jobs. That we desperately need that unemployment rate to keep going down. And then beyond that, there's always those unknown factors that could, really make things tough. What happens in Europe, not more terrorism, who knows? Those things no one likes to think about, but obviously could have an effect on our business.
Yeah, definitely. Although I have to say, what I see in brokering hotels around the country in different states, the local economy right now particularly is often divergent from national and global in that some of the local economies are doing great, and the local hotel industry is doing great. Some of them are still suffering, and so there really is a disparity between the haves and the have-not markets, if you will, and some areas are really doing well. So the local economy ultimately, I think, is going to trump the national and global economy.
Yeah, most definitely, and that's always been the case with the hotel industry. It's a street corner business, and if your community's doing well, then your hotel is probably going to be doing well.
Yeah.
I talked a little bit about development. And indeed, it is pretty far off. The pipeline of all hotels under some stage of development, and this is through May, I believe, is down 6% from the May of the previous year. So that's been trending down for a long time. Interestingly, however, this month or last month, 21% was a 21% jump in rooms under construction. I think now comes from a low base. There weren't very many hotel rooms under construction last year, but I think it is a sign that a lot of developers are taking small baby steps to at least start developing again. And I think we're going to see that sooner rather than later.
Yeah, I know of a number of projects where hotel developers, they started them when there was mezz debt that you could get to 85% loan to value in the debt stack, and suddenly that disappeared, and they've got multiple projects, and those projects have just been put on hold. But most of them didn't go away, and so I think now they're starting to get money for some of these projects. So
right, and a lot of them are, they're all prepared to go. They have designs, they have sites.
Yeah.
So, it's just whenever that switch is turned, I think you're going to start to see some more. It's been interesting in urban settings, particularly in New York City and others, that it's really select service is driving development there. There's been quite a few new hotels opened in New York City in the last couple of years, and I think maybe all of them, I'll say, that may be hyperbole, but all but just a few are in the select service category. It seems to be about the only thing that can get developed, particularly in urban areas. One wonders if there'll ever be another, big box convention hotel built ever.
Yeah.
Select
service is a little nebulous for me. Can you let's define it a little more closely. Select service meaning there is some food and beverage offering in the hotel, like a Hilton Garden Inn, versus a Hampton is strictly limited. Is that right?
Exactly. Yeah, it's best defined by talking about which brands that includes: Courtyard, Hilton Garden Inn, Hyatt Place, brands like that, where
Right.
there is food and beverage available, perhaps some small meeting space, but there's certainly not full-service hotels like one thinks of a Marriott or a Sheraton or something along those lines.
Yeah. Have you seen any numbers regarding new construction as to what percentage would be full service versus limited or select service?
No, not offhand. I didn't check that out. I did see something. In fact, it was just yesterday that Hilton, they're going to only open one full-service Hilton hotel, new construction full-service Hilton hotel this year, and it's in Columbus, Ohio. So I mean, that tells you right there that those kinds of hotels just aren't getting built these days. And that was a public-private subsidy thing, so otherwise it wouldn't have got done.
Yeah.
The other interesting thing is there are some areas of the country, really out-of-the-way places that are really doing well in terms of hotel development. The Dakotas, the Prairie provinces in Canada, and eastern Ohio and western Pennsylvania, and it all evolves around energy. It's fracking here in Ohio and the Marcellus Shale up in the upper Midwest, and those communities they can't. There's no hotels to be had, and so it's interesting how well those.
Yeah, I have seen hotels. For example, a Comfort Inn that was doing $900,000 a year on 75 keys. The gas industry comes in and it's doing over $1.4 million on 75 keys.
Yeah.
So revenues have jumped in some cases over 50%. And the meeting I came from, the guy owns a hotel in eastern Ohio in that area, and he's like full all the time. So
it's crazy. Now the question is how long it's going to last. Nobody seems to know that, and so that makes it a little bit difficult to make development decisions. I mean, if you're in Williston, North Dakota, there's no hotel rooms to be had today, but it could very easily get overbuilt if something happens to that industry from whatever point of view.
Yeah, and I guess oil is different than the gas, and I know gas, there's both the wet gas and the dry gas. Mm-hmm. Some people are saying the dry gas, they're going to stop developing as much for right now and focus on the wet gas, which has many more uses.
Yeah, so it's no thing's a sure bet, I guess, is the answer there.
Right.
The final point there is that the top 7 brands in the industry are accounting for about a third of the pipeline, but I really don't think that's any different than it has ever been. I mean, that's where most of the new development comes from. It's from the top brand companies. Mm-hmm. As you said, we've been doing this survey with HPI for nearly 20 years, and I just want to run through a little bit of the results of that survey.
Yeah, please.
Some of the highlights were that is something we'd said before, and that's the money seems to be everywhere. The lenders are virtually chomping at the bit to start lending some money. On the other hand, terms are a lot tighter. 80% loan to value is probably the norm now today, rather than the 50 and 60% of 5-6 years ago. And you don't know whether that's going to be the standard now forever, or at some point it's going to get back to the craziness. And a point you made earlier, it's strong sponsorship is a must. It's only the best are going to get the loans, and you really need to be a substantial company with a great track record and great financial history to get money today. Now, all this means, though, is that there's a lot more sanity, I think, in the lending market than there was back in the mid-2000s. And all in all, that's a good thing. Yeah.
I think then, there should be less defaults in the future. And hopefully the larger capital markets aren't going to have any wild fluctuations that end up affecting us indirectly as well.
Sure. Is from the survey, here's one of the quotes we got from one of the participants in the survey, and as you can see, this guy Max is very optimistic about hotel financing in this environment. He says, one thing in the second paragraph here, he says, it's not uncommon for us to receive a dozen or more quotes for hotel loan requests, and lenders are becoming increasingly competitive. So maybe some of these tighter terms are going to turn around as we move forward. Again, we're going to have to see.
Yeah, I was just speaking to somebody who arranges CMBS debt for hotels, and they were saying that whereas the bar was $10 million or $8 million minimum project, there are now CMBS lenders who are going down to $3 million, even $2 million projects. So
competition.
In some ways, at least, the underwriting is getting a little bit looser. And I think in terms of the markets, they're now looking at more secondary and tertiary markets, whereas before they only wanted to do primary, top 25 markets.
Sure. I was going to run through some of these slides from the results from the survey. As you can see, regarding the kinds of projects or kinds of loans that these lenders will make, seems like everybody will consider acquisitions and refinancing. There's new constructions are pretty high level there, and turnarounds and renovations, which are probably the same thing, is about 3/4 of the lenders say they'll get involved in those. And in regard of what kind of properties, it's select service again leads the pack of most favored by lenders, followed by full service, then extended stay, and seems like nobody wants to be in the timeshare business lending these days.
Yeah. Now I'm surprised that you say 82% of lenders would do new construction.
Well, I think that the way the question reads is they would consider new construction, as opposed to they actually do. So,
right.
And so, surveys, you got to be careful what they say and versus what they do. But given that many of the people in the survey field are local types of lenders, I think it's still a truism that if you're in Dubuque, Iowa, and you really have a great piece of property and you have proof that there's demand in that marketplace, and you have a great relationship with a banker, you're probably going to get a loan.
Yeah, and I see developers who have a proven track record with their lender and with the franchisor that they favor. They're getting money, and they are building more hotels.
Sure. Kind of the same question put a different way, looking at segments versus full versus select service. Here's the most favored segments among these lenders, and that upper mid-scale, which sort of translates into that select service segment, is the most favored by all these folks, and luxury is down at the bottom.
Yeah.
And in terms of types of loans that are being offered today, conventional loans still lead the list, and it goes all the way down to FF&E financing. Was interesting that reading a story the other day, and I think Crittenden report that mezzanine financing. They were speculating that mezzanine financing is going to start to get hot again, and I think, as you had said, LTVs are shrinking, or they're high right now, and so there's still that missing piece for many people looking to make a deal, and that's where the mezzanine piece can come in.
Yeah.
And so
the equity requirement is high. The loan to value is lower overall. On this, the types of loans offered under conventional, does that include SBA?
Yes. Yeah, that was part of the question.
Okay.
Yep. Because in many respects it is, conventional loan.
Yeah, I mean, for us, particularly since the SBA, Congress increased the SBA loan limit from $2 million to $5 million, it's made a big difference. And on the SBA 504 program, that $5 million can be in second mortgage position. So really, you're talking about, you can do a $10 million debt and a 12 to $15 million project with an SBA loan. So the capability and the dollar amount of SBA loans relative to the hotel they can build these days or buy is higher. So that's been a big help.
Yep. Finally, I'd like to sort of give you my thoughts on what's ahead for the industry in general. The first thing there, ignore the chaos. It was interesting at NYU. It was right a couple days before NYU, something happened in Greece, one of the downtrends in Greece. And everyone came into NYU kind of in a very pessimistic point of view. And I think the lesson is that we can't be concerned with these daily ups and downs of the world economy. I think everyone needs to kind of really be focused on what's important and not get too distracted by the larger issues while keeping them in mind.
Yeah, I agree that, it seems like we're in a constant bombardment of information from around the world, and some of it's always negative, and there's going to be this constant flux, and a certain amount of it you just got to screen out and focus on your market and where you are.
Most definitely. Another trend that we've been seeing and a lot of operators have been complaining about is erosion in profits. While demand and rates are coming back, it's not necessarily translating 100% into profit margins. And a couple of reasons for that. The PIPs, which we mentioned earlier, are costly. Consumer demands on hotels is somewhat costly. The demand for bandwidth is growing so fast and is so costly to hotels that it's eating into their profit margins. But yet, a hotel has to be on top of that part of the business, otherwise they're going to lose business. And then the other thing is something else I had mentioned before is regulations. The pool lift regulation is something that's that and other things can eat into profits, and also too as states, as the federal government and the state governments are cutting back on their services and their funding, a lot of cities are starting to raise their taxes, or counties, and that can have a negative effect on hotels as well. So the money's got to come from somewhere, and sometimes it gets down to the lowest level of government.
Yeah, absolutely.
I think we will continue to see improved performance in the business. There's hardly any real signs that things are going to get not going to continue to get better. That's for sure.
Yeah, I think most of the profit and loss statements we see, most hotels are certainly improving year over year for sure.
And again, it goes back to ignoring that chaos. I think that's what we should be focusing on is how well the industry is doing, not what if.
Yeah.
It's interesting to look at who's buying and who's selling hotels. Last year, 44% of hotel transactions were done by REITs, and that was mostly in the first half of 2011. They slacked off in the second half. This year, through the first half, REITs have only accounted for 27% of hotel transactions. And who knows what's going to happen with them for the rest of the year. So it's interesting to see how who's buying and who's selling these days, and that's something that's probably going to remain in flux for a while. We talked about the political uncertainty, and then I think the final thing is this. We may be entering a state of perpetual flux in our industry and in the U.S. economy and in the world. There always seems to be some next crisis down the road, and I think everyone has to adjust the way they operate to accommodate that without losing their nerve, I suppose.
Yeah, we're seeing some more visible foreign capital, foreign investors from China and Brazil coming as far as who's buying and who's selling.
Sure.
So that's interesting. And just recently, we've had buyers who said they've moved $5 million, $10 million into U.S. account, and they're looking to buy hotels. So I think with the European uncertainties, the U.S. market is still looked at as probably the best bet, the safest place for capital for a lot of people around the world.
Yeah, that's for sure, and I think we need to look at that and be optimistic based on those kinds of thoughts.
Yeah. Great.
And that's it for my slides.
Yeah, from the survey. Thanks. That was terrific. I enjoyed your article. You mentioned just a minute ago the consumer demand is requiring more and more investment in hotels and in technology. Your June 15th article on the argument for technology investment in hotels in lodging hospitality, I thought that was interesting, and I agree. And in some ways, I think technology can be you can get a lot of bang for your buck out of some technologies in hotels in terms of giving the guest a perception and a good experience that the hotel is up to date.
Sure, that seems to be where most of the technology investment's going to be made in hotels, is this guest-facing technology, things that the guests can touch and feel, and as you say, get that better impression of the hotel. But a lot of it is mandatory. It's hard to differentiate anymore in terms of technology. If you don't have that bandwidth that the guest demands, you're going to be turned away. If you don't have flat screen TVs with a lot of HD content, guests are going to be turned off by that. So, in many ways, it's a must kind of investment, and difficult to employ it in such a way that you're going to differentiate yourself. So that's the downside of it.
Does bandwidth go up at hotels as the rate for the room goes up? Does it correlate with chain scale?
I believe it does. I've never seen any hard evidence of that, but I believe it does. I mean, the more likely it's going to be a business hotel, first of all, there's going to be more likelihood of increased bandwidth demand. However, in that article, someone had mentioned that even on the leisure side, everyone, men, women, children, travel with at least one device, often two. So even when a family of four checks into a hotel for the weekend, everybody's probably got their own laptop or their own iPad or their own smartphone, and they're all, hungry for bandwidth. So, that's even a problem for hotels. It used to be someone would a business person would check in with their laptop. That's all they would need the bandwidth for. Now they probably have that, a smartphone, maybe an iPad as well. And then when they bring their family, everybody has their own stuff.
Yeah, well, plus, with streaming from Netflix and Amazon and other content providers, do you think is pay-per-view, is that dead? Or? Well,
everyone seems to think so. It's hard to find a rationale for pay-per-view anymore on any level. Now, those companies are trying to retool themselves into more overall technology solutions. But the paying $13.95 for a movie, they always had low buy rates anyway, less than 5% in good years. Now, I can't imagine anybody who's traveling with a laptop or an iPad, is buying a pay-per-view movie anymore.
Yeah, really. Do you think for hotels with a meeting room, is video conferencing something that they're going to need to invest in? Is demand increasing for that in a hotel?
I've never bought into that video conferencing is going to take over the world scenario. And while some big box mega convention hotels do have that technology and are expected to, I just don't see it ever being that big of a demand driver. I think most major corporations, big companies that require video conferencing already have it in their own facilities and don't need to go to a hotel to have it done.
Right.
So I just don't think
all you got to do is log on to Skype and you can do it. Great. Well, Ed, I really appreciate all of your insight into the hotel industry, the status and the report from the NYU conference, and of course, Lodging Hospitality and HPI's lender survey. So I want to thank you for being on today.
Yeah, it's my pleasure.
Thanks. And don't forget, everybody, to rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. You can download a PDF list of today's featured hotel listings, plus a selection of additional hotel investment assets listed by HBI brokers under the Attachments button on the top of the webcast player. We have also included a direct link to the Lodging Hospitality feature article, Who's Got Money for Hotel Financing, written by Ed Watkins. and you can click on that direct link to download that article. As a reminder, this and previous Hotel Investors Marketplace webcasts are available for on-demand viewing online at hbihotels.com. And don't forget to register for our next webcast, which is scheduled for September 12th, and will feature the latest market statistics presented by Jeff Higley, Vice President of Digital Media and Communications for Smith Travel Research, STR Global, HotelNewsNow.com. Thank you, everybody. Thank you, Ed. Have a great day.
Thank you.